plan, let's talk about current market conditions, and we need to answer a few questions, right? So first of all, let's look at the macroeconomic data. Today, it actually came in better than expected, right? Better than expected. Flash services PMI was higher than expected, and manufacturing data was higher than expected, actually above 50. Right, we dropped to 49, and now manufacturing data jumped above 50, which means expansion, and that was a positive surprise. And as soon as that data came in, yield had a pretty big rally, right? Because they started pull back with the expectation that it's going to be worse than expected, and as soon as the data came out, we have a strong rally in yield, which is a very important kind of distinction between March and prior to March, right? Prior to March, if you look at the the way market worked, is that when yield went up, that was bad, right? That means that inflation is strong and Fed is going to raise interest rates. Ever since probably the March 13th, right, when the Silicon Valley Bank, and we had financial distress, some of the banks went under, the correlation has changed, right? When yield is up, right, that's considered to be bullish, right? And you can see big reversal in spiders. We were down, well, not big, I think we were down maybe, what, 0.5%, right? So we were lower. We did pull back sharply yesterday after worse than expected economic data, leading indicators. We had a big pullback, yield drop, and now yield went up and the market went up. So the idea now, the new correlation is the theme has changed, right? Most people now not concerned with inflation because clearly data is showing deflation, right? Clearly we're seeing deflation across all metrics, even in services data and in shelter prices, right? So we are in deflation, maybe not to the target levels, but incrementally we're going in the right direction in terms of deflation. And now the theme has changed. Everybody now is concerned about recession, right? Because if the inflation is dropping continuously, then why is 3 months is at 5%, right? 3 months yields 5%. A 10-year yields 3.5%, right? And why does the market goes up, right? Why is spiders up when the 10-year yield is up, right? So fear of recession, right? Today we have better than expected manufacturing and services PMI data, so yield is going up, right? And the market drops because the expectation is that Fed is not going to pivot. Fed is not going to pivot, and interest rates will remain high. When yield drops, expectation that, well, economy is decelerating and potentially entering recession, so Fed will pivot. So that's the narrative, and it's very important to kind of keep an eye on these correlations. So as we're approaching the next 10 days, if you look at the stock forecast toolbox using our neural networks, it's basically market neutral, right? It doesn't know about the Fed meeting on May 2nd. It doesn't know about the earnings season. We're done with the first week of earnings season. It just looks at the tape, right? It looks at the price action. It basically says if the market reaches 412, it's probably overbought, and maybe it makes sense to sell, right, for the next 10 days for today. And then 408, probably a good buy for Friday. And if you zoom out for the next 10 days, potentially we can reach February high, right? 418, 419, 420. Next week, I think we're going to have, all the big guys announcing next week, right? Apple, Microsoft, all the mega cap technology. Let's see. 2 weeks, right? Is Microsoft next week? I think Microsoft is a little bit earlier. Yeah, okay. So you have Microsoft, we had Tesla, Microsoft gonna start announcing visas of the world. So next week is kind of next 2 weeks will be the peak of the earnings season. So then the question becomes, where are we heading in the next 10 days? Model basically sees if Microsoft delivers strong earnings, right? Potentially we can get to the year-to-date high, right? Which is this level, 415. Let me make sure you guys can see it. Yeah. So that's your February high, right? About 415, 416. And model says, well, based on earnings, and even though it doesn't know about earnings, based on the earnings, we can get to the 416, 420 level. If you zoom out and say, well, great, based on the current price action and the learning algorithm, right? This is a machine learning, and it makes projections for the next 10 days. For the next 6 months, it's projecting that on the upside, you can actually get, if the earnings are better than expected in the next couple of weeks, we can actually get to the August high, which would be 430. And the worst case scenario, if the earnings are not good, then we will retest December lows. Right, so if you go out beyond, April, like May, June, potentially we can get to 430 and better than expected earnings. That would be August high, or pull back to the 380 level. Granted, without having a strong opinion on the market, if you just kind of basically a technician, you can say, listen, looks like distance between current price and December low is 30 points, right? Or the risk is 30 points to the downside. And the best case for 30 is, 20 points to the upside. So risk versus reward, even if you don't have an opinion on the market, or you're just purely a technician, you don't really care, whether we will or will not enter a recession, you just look at the price action, right? Then the risk versus reward, it doesn't make sense to chase the market. If we do get to 420 especially, or 425, it makes sense to sell into the rallies. So that's the question, right? So going into summer, right? April is almost behind us, one more week. Then May starts, right? April was the best months, usually the best months of the year from seasonality. Not a lot of, not the best performance. It's kind of flat for this month. And you can see we're going through the top building process, right? We're going through the top build process. We had similar price action in December, right? October. We had similar price action here, right? We've seen these kind of top building processes that, sometimes last few weeks, right? And then they pull back, right? And then there's a pullback. Sometimes if the earnings are better than expected, right? Then, you have rallies, right? So then the question becomes, do we rally to the 430 level? Or do we drop to 380 level? Which level is correct based on what the model is predicting? Model basically says neutral trend, maybe slightly positive, but the best case scenario 430, worst case scenario 380. So as an investor, as a trader, going into summer, you have to pick the side, right? You can say, well, Vlad, we don't know. It's probably just going to be neutral, right? We're just going to trade at this 410 level. I guess that's a possible scenario 3. Right, kind of a sideways market. Scenario 1, we're heading higher toward 430. Scenario 2, we're heading toward lower December lows, right? So kind of very well-defined range, right? You don't even have to be have a PhD in technical analysis. You kind of can say, listen, we've been trading in this range for a very long time, right? One can actually say for years. If I zoom out to 2 years ago, you will see we're at the same level that 2 years ago. If I look at April of last year, we were at this level. And if I look at April of 2021, we're at the same level, right? I mean, we were much higher, we were much lower, but now we're in the middle. So for the past 2 years, market didn't go anywhere. And that's the argument for that we are in traders market, right? Because if you start investing 2 years ago, you don't know how to short the market, right? You just always buying. Right, then best case scenario in the 2 years, you're flat, right? Worst case scenario, you're probably down if you started investing 2 years ago. So how do you wear trader's hat? And the traders don't care about bull bear market. They care about price action, right? They see this as a sell signal, right? They see every time we hear it's a sell signal, right? And every time we hear it's a buy signal, right? This is how traders think, right? They look for these bottom building process, top building process, and price section. So let's put on our trader's hat and going into summer. Do you believe we're heading higher because Microsoft, Apple, Visa, Nvidia will deliver strong earnings, better than expected earnings, and the bar is set low, right? Very low, very easy to beat now. Versus 2, right? Bar is not set low enough, right? You have cases like JP Morgan, right, hitting a home run, or Abbott hitting a home run, and then you have cases like AT&T, right, or Regional Financial today, right, where more or less, or Tesla, right, worse than expected. So let's do that. 1, 2, or 3. 1, we think you're bull. You think we're heading higher because unemployment is low and the bulls have a strong case. 2, we're heading lower to our December support, December, March lows. And 3, you basically either don't know or you just think, listen, nobody knows, you're just going to trade in the range, right? You turn on Bloomberg, CNBC, and half of the contributors basically says you can't really time the market. You should, bottom-up approach, right? You just pick the stock that has strong fundamentals, high cash flow, high dividend, and and then it doesn't matter if we're heading higher or lower. Okay, so 1,